Welcome students of class 12th commerce in our business studies syllabus for class 12. Today my topic is capital structure. We will try to learn concept of capital structure and the factors affecting capital structure. Capital structure, the decision regarding the proportion of different sources in raising funds is also taken under financial management. According to Gutman and Dogale, from a strictly financial point of view, the optimum capital structure is achieved by balancing the financing so as to achieve the lowest average cost of long-term funds. This is turn produces the maximum market value of the total securities issued against a given amount of corporate income. The various sources of obtaining business finance can be classified into two categories. Number one, owners funds, equity, and number second, borrowed funds, debts. Owners funds, it includes equity share capital, preference share capital, and retained earnings. Ownership funds increase the financial strength of company. Second one is borrowed capital or debts. It includes debentures, loans, public deposits, etc. Borrowed funds carry two fixed legal obligations. Number one, payment of interest at a fixed rate on regular intervals of time, and number second, repayment of principal amount on maturity. Capital structure refers to the proportion of debt and equity used for financing the operations of the business. It can be calculated in two ways. Number one, as a debt equity ratio, that is a debt equity, and number second, as a proportion of debt out of total debt plus equity. Dear students, now we will try to learn the different factors that affect the choice of capital structure. You can see the following important factors that affect the choice of capital structure. Number one is cash flow position. Cash flow position, before raising debt, a company is required to consider its cash flow position. A company must have enough cash as it is disposal to carry out its daily operations, for investing in fixed assets, and for the payment of interest and repayment of principal. Companies expecting a large and stable cash inflow in future can employ a large amount of debt in their capital structure. Number second factor that affects the choice of capital structure is interest coverage ratio. The ratio indicates the number of times earning before interest and taxes of a company covers the interest obligation. High ratio is not adequate because sometimes the companies have high EBIT because but a less amount of cash balance as it is disposal. Along with interest, a repayment of debt is also equally important. Number third factor that affects the choice of capital structure is debt service coverage ratio. DSCR is equal to profit after tax plus depreciation plus interest plus non-cash expenses written off, preference dividend plus interest plus repayment obligation. This ratio fulfills the limitations of interest coverage ratio. Higher the ratio, better it is. It indicates company's ability to pay interest and the principal amount, and hence company is capable to opt for debt financing. Even profitable companies whose working capital management is poor face a liquidity problem. Serving debt is very burdensome for them. Number fourth is return on investment. Higher return on investment enables a company to go in for trading on equity to increase its EPS. Hence, company can increase debt component in its capital structure. However, the increase in use of debt has decreased EPS. And thus, in a nutshell, we can say that the return on investment is an important factor determining capital structure. Number fifth is cost of debt. The company can employ more debt in its capital structure if it is available at a low rate so that cost of serving the debt does not become a problem. Number six one is tax rate. The interest rate has a great impact on the cost of debt. Higher tax rate makes the debt cost cheaper and thus increase its use, and vice versa. As interest is charged against the profit by sharing interest as an expense, profit can be reduced, which relieves the enterprise from the burdens of tax to some extent. Hence, higher tax rate becomes an attraction for inclusion of more debt in the capital structure. And one more here is factor that affect the choice of capital structure is cost of equity. Shareholders expect a fair rate of return on their equity for bearing risk. And therefore, when a company opts for a debt finance, the financial risk increase and the desire of shareholders to get a return increases. Thus, a company cannot use debt beyond a certain limits because using debt beyond a limit increase the cost of equity and hence decrease in value of share in spite of increased EPS. Dear students, this all was about the concept of capital structure and the different factors that affect the choice of capital structure. And inshallah, tomorrow we will meet again with the next topic. Till then, Allah Hafiz.